Coordinator. We're being recorded. Thanks, Ellen. I'm the Coastal Training Program Coordinator for the Ace Basin National Estuarine Research Reserve, which is down between Charleston and Beaufort. And I will be your moderator today for our session on understanding flood insurance. We have behind the scenes, I've got Ellen Camo, who is your water resources agent with Clemson Extension down in Beaufort County. She's taking care of any of our technical problems. And Ellen, if you want to go ahead one slide for our housekeeping. So please keep your cameras off and your microphones muted during today. We have a lot of y'all on today. Oh, I just got muted. Here we go. So keep your cameras off and your microphones muted because we have so many. We try to preserve bandwidth that day. And if you have technical issues, sometimes you can click leave, which is that red box on the lower right-hand corner, and then come back in through the same link that was in your email. You can also ask for help via the chat box. And also at any time, if you have a question about our content today, please submit it via the chat box. If you'd go ahead, Ellen. All right, so today's speaker is Lisa Sharrard, and she can tell you more about what all these acronyms mean, but I just want to say that she has over 30 years of experience working with flood insurance and floodplain management. She's incredibly knowledgeable, and she is really excited to speak to y'all today. So Lisa, I'm going to let you take it away.
Fantastic, thank you. Let me share my screen here, and we'll get the presentation started. Good morning, everybody. And as Abby said, I am the former state coordinator here in South Carolina, and I have the pleasure of, let's see, I can move this over here so you can see that out of the way. Can everybody see my slides?
We are not seeing your slides yet.
Let's
just you.
Okay, let's do this right here then. How's that? There you go.
Perfect.
Fantastic. Thank you. Again, my name is Lisa Sharrard. I'm former state coordinator. I'm also an insurance agent and have been in the insurance business full time since 2010. I was the trainer for the ANFI Direct, taught the underwriters and customer service representatives how to write flood insurance policies before I became an agent myself after the 2015 floods. So we're going to get started. We're going to go through a few basics here. Number one, flood insurance is available for sale within the jurisdiction that participates in the National Flood Insurance Program. There we go. A little bit of a delay there. You can purchase flood insurance in the community if they're participating in the NFIP. The flood insurance is available for sale within those jurisdictions. For some reason that's not loading. Let's try it one more time. And the NFIP is a program run by Congress. There we go. Congress has to reauthorize the program every, couple of years. Well, the program last expired in December 17th, 2017, and it's been extended. This has changed from September 30th to March 11th now. So we have 19 short-term extensions. We're now to March 11th, 2022 that the program is extended through. And so sometime this month, they'll probably do another short-term reauthorization to carry us through to probably September 30th. So the National Flood Insurance Program has gone through a huge transition right now. They're going from a legacy rating program into risk rating 2.0. The basic things for flood insurance have not changed. The amount of coverage is still maxed out at $250,000. The amount of contents coverage for building was $250,000, $100,000 for contents coverage. And the deductibles, are still the same, except we have a few more options they've made available to us. We now have a flexible $10,000 deductible available for us. So there's a few little changes and some things stay the same. But the key is that, the rate tables were published in the flood insurance manual. and now they're not. The rates are not published in the manual, so it's a little bit harder to figure out what triggers flood insurance rates to go up or down. And this is what the advice I'm going to give you. If you're not a licensed insurance agent, you need to find a trusted advisor to work with who is licensed, who can help you with quoting flood insurance policies. Those advisors are going to keep, in the buying and selling process, are going to help find the most beneficial rate for their clients. They're going to help them understand what the true risk rate is, understand declarations page, the glide path, what coverages they have, what coverages they need, renewal quotes for buyers and sellers, and can get the true claims history for sellers and buyers, helping them get through that process. So that's a hard one to do right now. So risk rating 2.0 is intended to really provide fair rates for everybody. The fair rates in that the houses built in 1950, the average square foot for a house built in 1950 was about 100,000 square feet. In 2000, that jumped up to 2,200 square feet. So the cost of materials and everything has changed over the years. And now we need to change our rating system to reflect replacement cost data. And that's a huge thing going into change is hard, but but people are across from each other are paying different rates. People who are across the country are paying different rates. They're paying the same rate, if you're in Charleston as you would be in Idaho. So the new rates reflect the cost to rebuild. So what's changing? We're eliminating the use of elevation certificates in order to write a flood insurance policy beginning October 1 for new business and April 1st for renewals. We're no longer going to use the base flood elevation nor the flood zone in order to write a flood insurance policy. The flood zone will still be used for community compliance. Elevation certificates will be used for community compliance as well. And base flood elevation will be used for that, but we will not use the base flood elevation or the flood zone in order to write a flood insurance policy any longer. We're trying to increase the investment in mitigation, so we're expanding the mitigation credits, we're expanding CRS discounts. We're also addressing the inequities that have existed in the program. We're leveraging better information, reflecting prior claims, and factoring the total cost to rebuild. So the current methodology, I said, takes into account the flood zone, the base flood elevation, the foundation type, and the structure's elevation in relationship to the base flood elevation. It only looks at the 1% chance flood frequency, and then you had a bunch of surcharges on there and fees. But the new methodology looks at some FEMA data. It'll look at distance to water. It'll look to see whether or not the structure is subject to storm surge or in the floodway. But it's also going to pull in some additional data that's not been utilized before. The other issue that, like I said, it's going to factor in the cost to rebuild, replacement costs. It's going to look at the distance to river, ocean, coast, the flooding source, the river class, whether it's fluvial or pluvial flooding, ground elevation, first floor height, construction type, foundation type. It's going to look at a broader range of frequencies. We had X zones that had really cheap policies. And after the flooding in Houston, we saw a lot of structures that were in X zones that were flooded. And so FEMA is now looking at X zones, and those rates that we saw under preferred risk policies, those are going up. And then you've got the FEMA surcharges and fees that are mandated by Congress. So the investment and other resources that FEMA is making, they're partnering with other groups like CoreLogic, USGS, FEMA, NOAA, U.S. Army Corps of Engineers, Milliman, just a broad group in the public and private sector to help develop this new rating system. So under the current methodology or the legacy system, the highest premium you can have for a single family structure was $45,925. But under the risk rating 2.0, that maximum rate drops down to $12,125. That's a big difference. So risk rating 2.0 does have a positive effect. So here in South Carolina, you're looking at this broad spectrum of policies. We have a little over 200,000 policies, and 26% or 53,253 policies are going to see an immediate decrease in their premiums when they come up for renewal, or when FEMA fixes the patch for those policies that renewed after October 1, we will be able to apply once FEMA releases the module that lets us do endorsements. So that's a pretty big jump. The other thing you're going to see is 65% are going to see their policies go increase anywhere from $0 to $120 a year or $10 a month. And that's about 138,000 policies. There are 6% or 12,469 that are going to see their policies increase $10 to $20 a year, and 3% on average are going to be greater than $20 a month. That's because there's something that maybe there was a policy error. They were, entitled to some benefit that they were receiving a benefit they were not entitled to. So that's most likely going to be a correction in a rating error that was discovered. So again, you can see here, most of our policies along the coast are about 62,300 along the coast. And we have about 208,600 policies in force. The average claim payout's been $27,100. And the average individual assistance claim payout the last 10 years has been $3,600. So it pays to have flood insurance. What can you do to mitigate? If you look at these by class, you have your preferred risk, you have full risk rate. We have about 122,000. We have newly mapped. We have about 2,000 policies that are newly mapped. We have 2,384 high risk policies, about 19,000 pre-firm subsidized. And then we have a broad class of preferred risk policies. And those policies are going to see rates go up or down. They could go either way.
Lisa,
the legacy system. Yes.
Can I jump in with a question real quick?
You sure can.
Two great questions from Sandra. And one is, why is Georgetown County missing from the previous slide you had on flood insurance about where your policies were?
Well, because we looked at the highest rate. If you go back, they don't have a high concentration. They do have policies in force, but you see the scale at the bottom where you've got, the bulk of the policies. It's just the way it's shaded for whatever reason.
Okay, so you do have data.
We do have data there, just not a significant number of policies in force.
Okay. And then also you'd mentioned community compliance earlier, and just wanted to know what you meant by that.
So communities have an ordinance which they have to adopt and enforce in exchange for participation in a national flood insurance program. So that's what I mean by community compliance.
Perfect. Thank you. Okay.
You're welcome.
Onward.
All right. So we have about 92% of the policies that are rated under the legacy system that are, changing. And risk rating 2.0, you can see that 92% would have seen an increase this year. Okay. Just a standard increase, the premiums would have gone up. But if you look at risk rating 2.0, 23% are going to go down, 66% are going to see a small increase, and so forth and so on. But, there are a lot of people who say the rate's going up, 23% are going to see a decrease in their premium. So it's really spreading that equity across the board and looking. And this is an example out of North Carolina. Like I said, 26% are going to see an immediate decrease, 65% are going to see that change. And then 9% are going to see 10 or more dollars a month increase. You know, a lot of people are going to see, like I said, are going to see, you know, a decrease. Some of them, this sort of single family policyholders are going to save about $100 a month. About 4,800 in North Carolina will save $100 or more a month decrease under risk rating 2.0. And those characteristics transfer into South Carolina. So we talk about a glide path. You know, everybody talks about the rates jumping up. Well, if you already had a flood insurance policy prior to October 1, or actually August 30th was 30-day wait. If you had purchased a house, you had flood insurance, you're going to be on a glide path if your rates are going up. So your rates aren't going to jump up automatically. There's an NFIP statutory maximum rate increase of 18% a year for primary, and 25% a year for business, condos, or non-primary structures. So it's up to that amount. Doesn't mean it exactly will be that amount. Most of the increases have been around 9% a year. So this is a slide I just pulled from, you know, a presentation I did on realtors, but this is what everybody needs to see about the deck pages now. We have the flood insurance, the current flood zone is going to be on there because the lenders have to see that. And that's pretty important. But the other thing you're going to see here to the left, you're going to see claims data. On the NFIP policy declarations pages, now you will see prior claims data. It is not reliable. It's only as good as FEMA's repetitive loss database is. So the, for example, the homeowner can call the Flood Map Service Center and ask them to provide a copy of the claims data, or FMIX, and get that claims data provided. They'll send them a form they've got to fill out in writing and have notarized because of all the Privacy Act. But a homeowner can find out how many claims they have, and FEMA sends that out every year, how many claims you've had. So the prior NFIP claims is important because, you know, if you're looking at buying a house or selling a house, or you're trying to figure out whether or not you should file a claim, you know, for something small or not, then this gives you some opportunity to figure that out. The other thing is that a clue here, repetitive loss structures are all written under FEMA's NFIP Direct book, and their policy numbers begin with RL. Anytime you have a policy number that begins with RL and you see prior claims as 0, that means there's a issue with the repetitive loss database. And I actually had a severe repetitive loss property who had 6 claims and but when we ran the deck, it pulled up 0. And that was because it had 2 repetitive loss numbers assigned to the same property. So it couldn't figure it out. So it just said 0. So don't rely on this number as being 100% until FEMA gets the repetitive loss database cleaned up. So it used to be we would see base flood elevation on the deck page. We no longer see that. Now what you see is a first floor height. And in this, and then the method which is what was used to determine that first floor height, which in this case is FEMA determined. You'll see 1.0 is the first floor height, and then FEMA determined as the methodology. If it was determined using an elevation certificate, you would see elevation certificate there. You come down here, you're going to see the contents coverage, the building coverage. You're going to see increased cost of compliance charges. You're going to see something called a mitigation discount. And we're going to go over that here in a few minutes. Then you're going to see the community rating system reduction. That's the credit for CRS. You're going to see the full risk rate premium. And so let's say you have a house that is on a glide path. It's going to tell you over time, and it may be 20 years before you get there, but this is what it's going to cost you for flood insurance down the road, the projection of the future cost of flood insurance. Then it's going to show you your annual increase cap discount, which is that 18 up to 18 or 25%. It's going to show you newly mapped discount. If you're newly mapped in a flood hazard area, they used to have that newly mapped PRP policy. They no longer have that, but they will give you a credit because this is a statutory discount that is required. You're going to see the total discounted premiums. You're going to see your, now we kick into the fees. Here's your reserve fund assessment, your HFIA. This is your primary, non-primary charge. It'll be either $250 or $25. You'll see your federal policy fee. You'll see your probation surcharge, and then your total annual premium. And so this is what you're going to pay today. So as you can see, this one was written with full risk premium in mind, and the surcharges just really kick it up a notch. This one is a non-primary, and that really adds to it.
Lisa, we had some questions about this first floor height. One being, how much does first floor height affect the cost of insurance?
Well, you know, FEMA is approximating it. This is one of those services they're receiving from a third-party vendor. And it doesn't, and I'll have a slide I'll show you in a few minutes that's 4 feet above, and they're paying like $300 now. And over time, they're going to go up slightly. It may double, but it doesn't really affect, and it's not always right. Like I have another one I've been working on that I have an elevation certificate on. And if you have an elevation certificate on it and FEMA has determined the FEMA will use whatever's in the cheapest that comes out cheapest.
Okay.
So the elevation certificate I had said it was a 2-foot crawl space, but FEMA said it was 9 feet. And so it defaulted to the 9 feet, even though that's not right. It's how it's programmed to do.
Okay, so we had another question about what was considered first floor height on a townhome, the garage level or the first floor living space. And are you saying that's going to be whatever's cheapest?
So they look at 3 things. They look at C2A, C2B, and C2, I think it's F, which is a lag. So they look at the bottom of the crawl space, they look at the next higher floor, and they look at the lag. And they come up with first floor height.
Interesting. All right.
Yes, it is. And we don't need elevation certificates anymore. You can actually, to complete section C, you don't have to go out and hire the surveyor. You can actually complete section E yourself, and we can use that to rate your policy.
Wow. All right. Thank you.
Isn't that amazing?
We'll move ahead. Yep.
Yeah. All right. So anyway, the deck page looks different. Pay attention to it. But it gives you a lot of information on it. So replacement cost value is not market value. And there's a lot of confusion. People will look up on Zillow and say, the property's selling for or just sold for. And that is what somebody would pay for it. But replacement cost value is if I take the entire structure and I break it down by its components. What is it going to cost to rebuild it like new with no depreciation for age or condition? And that is replacement cost value. The 5 factors that go into replacement cost value are the zip code, the building square footage, the number of floors, and if it's a condo or multifamily, the number of units, and the date of construction. So those are the 5 elements in an application that are going to influence replacement cost value. And I always tell my, the insurance agents that I teach, do not rely on replacement cost value or square footage from a real estate agent's listing. Go to the tax assessor's page, because sometimes, listings are a little embellished, or they add in things that we would not consider as part of the square footage, the habitable square footage. Like we don't include decks or porches or garages. We would exclude that from the square footage. We're just looking basically for the heated square footage. So we'd like to recommend they go to the tax assessor's website rather than looking at the listings on the internet. So there are a couple ways to lower and save money with risk rating 2.0. Number one is the newly mapped discount. That's statutory, that's there. CRS has been around for a long time. Deductibles don't provide the big discounts like they used to because the premiums are lower. And then the new one is mitigation discounts. Mitigation discounts are going to be for proper flood vents. Let's talk about proper flood vents. We can get openings discounts for flood vents that are properly installed, and you can use that for structures that are elevated with an enclosure on post, piles, or piers. With an enclosure not on post, piles, or piers, solid foundation walls maybe, or a crawl space. Those type foundations can receive a discount for proper openings. And what are proper openings? Same thing they are for floodplain management. All the enclosures below the elevated floor must meet their following requirements: a minimum of 2 openings on 2 separate walls. You have to have 1 square inch for every square foot of enclosed space. And they have to provide, they can be no higher than 1 foot above grade, and they have to provide total net area. That means if it's got a covering on it, you've got to allow for that loss of that louver or covering on it of not less than 1 square inch of square foot for every square foot of enclosed area. So that's the same, it follows the same floodplain management logic. So let's look at machinery and equipment. This includes appliances. This one's a little bit more tricky because if you look at this one here, for a slab on grade building, for them to get credit, all the utilities and appliances would have to be elevated to the attic or floor level for a 1-story building. That's really just not going to happen. So slab on grade structures are not going to get credit for machinery and equipment or appliances being elevated above the first floor. In a basement, they have to be elevated to the floor above the basement or higher in order to get the credit. You can see here elevated with enclosure, posts, piers, or piles. And what we see a lot for machinery or equipment is if you look at the elevation certificate, it gives you that. But the machinery equipment has to be the platform that it sits on has to be above C2B. And what we're finding is that they're really, it's not. It's at or within 6 inches, but it's always below because they want to line everything up visually. And so it does not line up with the top of the floor. And so that is something new that floodplain managers need to share with their insureds, who are trying to build and save money and maximize the discounts on flood insurance, as long as developers who are trying to maximize discounts. All they have to do is raise that platform another 6 inches. So we're not looking at base flood elevation any longer. We're really looking at going above that first floor height, which is a different mentality, because base flood elevation could be 4 inches off the ground. And we're really looking at the height of the next floor. So these are some examples of where you would see, where we need to see the utilities and appliances elevated to in order to get the M&E and appliance discounts. Here's another example. Crawl space is going to be on the first floor, no utilities in the crawl space whatsoever. Here on the top one, there would be no appliances or machinery equipment located in that lower level. So grandfather, everybody wants to know, base flood elevation is changing. The zone is changing. Am I going to be grandfathered? What's going to happen to me? Well, I'm in a V zone, So if you're a legacy policy, meaning your policy was issued on or before October 1, and you're grandfathered, you're going to be on a glide path, either for zone or BFE. So you're going to be subject to the up to 18 to 25% year premium increases, just like everybody else, but you're going to keep that initial rate you've got. Structure 2 here, the base flood elevation changed. Is my premium going to be impacted? And the answer is no. And the reason being is that, for for risk rating 2.0, we don't look at the base flood elevation as a factor of rating. And the same thing with structure 3. We have zone change. There is no change. There's nothing going to be impacted because we just don't look at BFE or zone any longer.
So Lisa, just to clarify, I know we had a lot of questions come in from registration about when were new flood zone maps going to get approved. And you're saying that doesn't really matter for your insurance premium, correct?
Exactly. The only thing that really matters for is whether or not a mortgage company is going to require you to have flood insurance now or not. We don't use the maps, the in or out for rating at all. So the in or out doesn't determine your flood insurance premium any longer. So a lot of people used to go get a letter of map amendment so they could have that preferred rate. Flood insurance would drop. We don't do that anymore. As a matter of fact, we see X zone policies going up.
Okay.
So, there you have it. So this is an example of a riverine structure under the legacy system. The date of construction was 1900. So, most likely it doesn't meet the requirements. It was pre-firm subsidized, and it was in an AE flood zone. It was on slab, one floor, 956 square feet, and they were paying $5,958 under the legacy system. Under risk rating 2.0, the replacement cost value is $200,000, and their premium is dropping down to $1,547. That is a huge savings every year. This is a high value coastal built in 1967. It's 100 feet from a, in a VE zone and an AE flood zone. So it's close to a V zone, it's close to tidal water, but it's not in a tidal storm surge area. It's slab pre-firm. The current premium is $2,488. It last sold for $1.5 million, which is not the replacement cost value, because we got to remember, we don't look at the value of the sale price. We look at replacement cost value, and the premium increased to $7,669. So that they're on a glide path. They're not going to jump up automatically. And it's going to increase 15 to 18, up to 15 to 18% a year, 25%, depending upon the class, and over the course of time. But it will not automatically jump up to $7,669 unless they let that $2,488 policy lapse. Then it will go to it'll void the glide path. This is the one we were talking about. This is in a beach community. It's not oceanfront, but it is in an VE flood zone. It was built 4 feet above base flood elevation. It was a slab, and they elevated it on pilings. 3 floors, it was $474. The risk rating 2.0 premium, based on replacement cost value, now brings it up to $893. So it changes slightly, just about doubles it. But this is for a structure that was built 4 feet above in a VE flood zone. So it's not always determined about the zone or base flood elevation, but they have determined the risk is fairly low. And this is on the glide path. So severe repetitive loss properties, I'm seeing the biggest discount in. I have a lot of SRL properties that I insure in my agency. I look at it this way. This year, when they come up for renewal, is the recalibration year. We're calibrating the rates from legacy to risk rating 2.0. We are seeing severe repetitive loss properties decrease in value, in premium. So I had one that jumped, that's getting a $10,000 refund. And that is because of the calibration between the legacy system and the risk rating 2.0. Under risk rating 2.0, every property is giving a fresh start until they make their next claim. When they make their next claim, they're going to have a 20-year rolling period that we're going to go back and look at the claims history. Under the legacy system, we went back to the first claim, if it was 30 years ago, 40 years ago, inception of the program, and we would capture those claims. Now we're only going to go back 20 years, and that's going to eliminate all of the Hugo claims that we had, which is really going to help people out. Then they're going to, when they make their next claim, we go back and assess the number of claims they've had in the last 20 years. They're going to apply a claims multiplier, and that will start that increase in rating of the premium again. But this year, until they make their next claim, is going to be a calibration year for those policies. So for example, here's one that was built in 1977. It's an AE flood zone, slab 1-4, 1,456 square feet. The premium is $7,200. Replacement cost value is $229,323. Their premium went down to $1,978. That's a big jump. Severe repetitive loss properties were pricing people out of their houses or out of the ability to afford flood insurance. And severe repetitive loss properties are held hostage because the only way they can get any help in most instances is they need a grant. And not all communities are willing to go through the grant process to either elevate, demolish, or relocate their structures, for example. So again, hook up with an insurance agent or a trusted insurance advisor that you can work with. It's going to help you understand risk rating 2.0, understand what premiums are if you're looking at mitigation, credits, what kind of savings they can be. They can help the property owners get that claims history. And, please, whatever, don't let policies lapse. A lot of people pay off their mortgage and say, I don't need flood insurance any longer. My mortgage is paid off. And they let their policy lapse and they go back to get a home equity loan later because they need one now. And now they're going to be rated under the legacy system and they will lose all grandfathering. They can reduce coverage. They can increase their deductibles. They can do anything, but as long as they have a policy in place, they're going to have that grandfathering. Once they let that policy lapse, they're going to the grandfathering goes away. Realtor.com is a great website. You go on there, you can find a house for sale, and they will give you a property flood risk assessment. This is a marketing tool. If you scroll down, they'll give you a quote. This is not a definitive source of whether or not the structure is in a flood zone. We have seen structures that have had letters of map amendment done, map revisions done, and they tell you that these zone determinations are not guaranteed, that this does not communicate risk, but they're trying to give you a idea and lead you into clicking the next box further down on their page that would initiate a quote and sell you a flood insurance policy. So this is not the definitive answer of whether or not a property is subject to flooding. So I want to point that out because a lot of people look at the internet for information. FEMA is that definitive source, and you should print a copy of the ferment for your files. If your floodplain manager or realtor or insurance agent, if there's any question. You can get a comparison of the flood hazard preliminary maps using FEMA's map comparison tool. This is pretty cool. The map on the left, which is effective map, is didn't have a DFIRM, so there was no real information available, but you can see the preliminary map on the right-hand side. It provides you the estimated BFE or flood depth, the map panel number, lat long, and the preliminary issue date and the flood zone. So that's a pretty cool tool to use. I thought I would share that. To request claims data, it has to be initiated by the homeowner. They can call this telephone number, which is the FMIX, or they can, the MAP Service Center, or they can email the MAP Service Center directly and request the information. They'll be sent a form which has to be notarized and returned to them before the will release the data. It is not a quick and easy process, so it's not going to happen in 24 hours. Private flood, private flood is the new kid on the block. Private flood is great. It was until risk rating 2.0 would undercut the NFIP because they eliminated all the fees and surcharges. But FHA loans will not accept private flood. FHA is supposed to make a decision this month on how the rules for accepting and allowing private flood insurance policies. But at this time, they have not. So if it's a FHA back loan, it's going to have to go through the federal flood insurance program. Here are a couple resources for you. The first one is risk rating 2.0 and the elevation certificates using section C or E for the first floor height. That's put out by ASFPM. The MAP Service Center, and again, the preliminary MAP service comparison tool. And if you're interested in looking at the flood insurance manual, you can just Google NFIP manual 2022, and you're going to be looking at the October 2021 edition. It'll take you to the most current one. And now I'm going to open it up for questions. This is my contact information down here. We're going to go to the chat here. Let's see if we can go to the chat and see what we...
I got quite a list for you, Lisa.
Okay, good.
I love it. So we're going to start with, we had several questions about cost and if the cost was set by the government or if it depended on which agent or agency you went through.
Replacement cost?
Or cost for flood insurance.
Okay, so the cost for flood insurance is set by FEMA. If all of the agents put the information in correctly, we should end up with the same result. However, if we don't put the information in identically, then we're going to end up with different answers. Replacement cost is calculated by FEMA. So that levels out that playing field. I used to see an agent would write the flood policy with a replacement cost of $250, and then write the homeowner's policy, same agent, with a replacement cost of $567,000. One of them was not right. In the flood insurance in the VE flood zone, that was used to calculate insurance to value, and that was a factor in the calculating the premium. So since $250 was the maximum you could purchase, the insurance agents sometimes would just put $250 so they could show they were 100% insured. But in actuality, they weren't, because the replacement cost value was $567,000. So if everything goes in, we should end up with the same answer, except the coverage and deductibles may differ. But if all those match, we should come up with the same premium.
Okay. So following up on that, I had a question about that replacement cost value and if the current high building costs are being taken into consideration.
FEMA updates the replacement costs. It used to be the updates to the rating system, the rating engine took place October and April. Now they take place on a daily basis. So when there's new replacement cost data available at the end of every month, that data is being factored into premiums. And I can quote policy today and get one rate, go back in it tomorrow and get a different rate. And that's because the replacement cost changed overnight.
Wow. All right. So I did have someone asking, this is kind of about cost and coverage, following up on that. The idea of you said the $250,000 maximum. Someone asked what they should do if their house is worth more than, they said, $300,000 federal flood insurance maximum.
Right. So private flood insurance policy will sell you a private policy up to $1 million, 1.2 million, depends upon the company. Or you can buy the NFIP policy, which I think is the best game in town, and get an excess flood insurance policy for the additional $50,000. Your agents should be able to help you with that.
Great. All right. And what all is our flood insurance for a home going to cover?
Well, if you take the building for building coverage and you take the house and turn it upside down, everything that does not fall out or is tethered, like your appliances, would be considered building coverage. There are limitations in lower areas, lower enclosed areas, but if the rating floor is, let's say you have a slab building, if you have slab construction, everything above that slab would be, should be covered. There are some limitations on contents coverage, what they will cover, but there is a thing called a policy form, and they're available. If you have a dwelling policy, just Google NFIP dwelling form, and it's a very detailed document that tells you exactly what's covered under that policy.
Okay, so read your policy. That's your best advice.
Exactly.
It sounds like.
Don't ask your agent. Read the policy.
Read the policy.
Because that's what the agent should be looking at when they're answering your question.
Great. And then I had a question from someone. It said, what does flood insurance cover in terms of water damage from hurricanes? Asking about wind and water damage. Is that our flood insurance or is that different insurance?
So rising water, if you have 2 or more properties, is a flood. Okay, so you're looking surface water, 2 or more properties, or 1 property that's 2 acres in size. So it could be the road in your house, so you may have a runoff problem. It could be your neighbor's above ground swimming pool accidentally collapses and creates a flood in your house. That would be covered by your policy. Or it could be a hurricane storm surge where the water comes in from the bottom up. Now, if you have a roof leak or wind-driven rain or a window break on the upper level and it creates a water damage inside your house, that would be covered under your homeowners and wind policy.
Great. So it sounds like we need both if we're going to be really protected.
Areas,
yes. And so you're saying if you're in a coastal area, which I think most of us are on this, a lot of people are asking in various ways, do I need insurance? And you just mentioned a couple situations where we would. Did you want to expand on that?
Oh, I'd love to expand that. If you're asking, do I need flood insurances? Then you have this feeling that you probably ought to have a policy and you're just waiting for somebody to say, yes, I need to buy a policy. I have a house, that is in zone X. The floodplain's across the street. I sit up a little bit higher, but I know that over time, that water eventually is going to be creeping up, whether it's, sea level rise or just a cycle that we're in where we're getting more intense storms. Our soils are more saturated, and I have that policy for peace of mind. I may not have full coverage, but I have some coverage. So you need just to evaluate what your risk is, what you perceive your risk is, and some coverage is better than none. But I highly recommend everybody getting a policy.
All right. And if we need to get a policy, obviously we want to talk to an insurance agent, but are there any good questions we should ask or ways to figure out who we want to go to?
I would ask about, like, I had an agent tell one of my new clients, she asked why the rates are going up. Why is flood insurance so expensive? And the agent says, well, that's just FEMA ramping it up. Well, that's not true. And if your agent is, making comments, not doing research, doesn't speak flood language, or is not very detailed in their answers, you may want to find someone who can give you those specific answers, or who's going to do the research and says, I don't know. Let me research and I'll get back to you. The woman who said FEMA was just ramping up just got a $154,000 refund because she had 2 houses and was being overcharged for both. So I see one comment here on, should communities continue to work to improve CRS ratings? Or does risk rating 2.0 eliminate the need for CRS rating improvement? Absolutely not. The biggest way we can lower flood insurance premiums in a community now is going to be through CRS. Because the premiums came down, the mitigation discounts that we were able to award for openings or the appliances and M&E being elevated are limited now. For example, I did one the other day, the premium was $1,900. And, if he put in flood vents, how much money would it save him? Well, it'd save him $8. So that's really not going to be cost beneficial, although I did advise him that it would save his foundation from collapsing if he did put them in. But from an insurance perspective, it's only going to be $8. So is it cost beneficial to reduce the premium? No. However, CRS is the biggest way that we can impact the flood insurance premiums now for our insureds in our communities.
And we did have a question about this come in, just what is the community rating system in general, and what does that mean for your average homeowner?
So the community rating system rewards policyholders for communities taking actions that mitigate or reduce the impacts of flooding in their community. It could be outreach, it could be planning, it could be freeboard. There's a number of things that can be done. It's quite detailed, and there's a lot of record keeping involved, but it is really worth it for communities to do for that insurance, because that can be a significant savings where you're looking at 10, 15, 20, 25% savings.
All right. And a little bit on the same vein with the risk rating 2.0 changes, are there anything that counties or communities need to do? Or is that all just going along at the federal level and just pay attention?
Look at the data. If you have better data that you can submit to FEMA, maybe on first floor height, maybe you have gone through and surveyed every structure in your community and you have that data and you can provide that data to FEMA, then maybe that's something you want to do. If you've done new topography, you want to supply that data, submit it through the Map Service Center and get it approved through the LOMAR process for utilization in your community. That will help us with our, the rating engine. If you see something amiss, like I saw with the 1 foot, 9 foot version of the first floor height, that's something that probably needs to be pointed out, and that'll get caught because I entered both in there, and FEMA will be able to identify that as an error. But we'll see the little things as we go along. But the key is identifying those things and really working on the data, improving our local data so that we have better information. I see one question: when will the calibration period be completed? When all the policies renew and are converted to risk rating 2.0.
So that's going to be further on down the line.
It's going to be within the next 12 months.
Okay, good.
Okay.
It's a great time period.
Everybody ought to be there the next 12 months. If you have any questions with me, my contact information is there. You're happy to email me afterwards or give me a call. I'll be happy to chat with you.
All right. Yeah, I think we hit the top questions people had. We are going to sort of put together a fact document that goes out with the PDF of the slides Lisa's agreed to share it, and we will also send you a link to the recording. It will be on our Flooding 411 YouTube page, so anyone can watch it, but we'll be sure to send it directly to y'all who registered so you can find it really easily. And
I see a couple of questions here. One asks where the declaration page comes from, and that comes from the insurance agent, and the insurance agent fills out the application that generates that paid once the document when the premium's paid.
So it's important to have a real estate agent who understands all of this as well.
Insurance agent, yeah. And your crawl space or garage enclosures that are used for solely parking, storage, and building access are not considered the first floor height. That's correct. We no longer look at crawl spaces or anything like that anymore.
Okay, thanks for clearing that up. All right, I think we are going to conclude. Ellen, I think, has our next slide for a save the date. So how Lisa was saying, the maps don't matter for your insurance premiums anymore, but they do matter for other things. And that is going to be a topic we are going to explore in our 4-part Flooding 411 webinar series that is going to be in June of this year. If you caught some of them last year, we are updating and expanding. So that is going to be Wednesdays in June online. If you were registered for this, we will make sure you get all of the information for those webinars as well. They will be free. Please share them with everyone you know who you think could use them. And we are also going to, again, send you a follow-up email. Ellen's put that Flooding 411 website in the chat. And then we also have an evaluation for you to fill out. Ellen's going to pop that in the chat. So please do the evaluation so we can continue having good things that help y'all out. People are saying this is helpful to them, which I love. And just again, thank you so much to Lisa for spending your time with us today. We really appreciate it.
Thank you guys for having me. I'd love to come back in about a year.
Yeah,
all over again.
Good.
Thank you.